This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, so let's go through and look at another accounting standard that is familiar to you from the days of financial reporting, but in terms of examinability, it just cranks it up a notch in terms of the level of difficulty. So remember, what you've seen previously under financial reporting is that your IFRS 5 standard effectively splits up into two, doesn't it? And looks first of all at what happened on the statement of financial position with regards to an asset, so usually property, plant and equipment, whereby you've then made the decision to sell that asset. So therefore, that asset is now no longer a non-current asset. It is not going to go through there and generate you benefits for the foreseeable future, i.e. longer than 12 months. Those benefits are going to cease when we sell that asset, and we have agreed to sell that. It's very likely, it's highly probable, and we're going to sell it there within a year. So therefore, we need to move it down from non-current down to current. So that's what we'll go through and look at first in terms of the SFP. Again, the rules haven't changed, but it does become more complex at this level. And then when you're looking at your discontinued operations, that's looking, again, if you like, a presentation element within your financial statements, but thinking more about the presentation of the results from that operation on the statement of profit or loss, and whether or not they should be separated out from your continuing operations, whereby you're going to generate revenue and incur costs and then generate profit for the foreseeable future, or whether or not that operation has been sold, or maybe that operation you are looking to dispose of, and therefore we should separate out those results because that is more relevant to the users of the accounts, isn't it? It gives them more faithful information by showing the users what results we may not be incurring in the future because that operation is going to be discontinued. And in the recent past, whether that was P2, corporate reporting, or the now new SBR, strategic business reporting, we have seen IFRS 5 crop up quite a few times, and that's primarily been dictated by the economic climate and what has happened within business. So if you start thinking about the economic climate, there's been recessions in recent history, so therefore businesses have started to look at cost saving and closing down operations of a particular business line or maybe of a particular location. They've been therefore then looking to offload some assets that are no longer being used to generate the profits that were expected. And if you think likewise as well, if you think about the change in the environment with regard to consumers and shopping, it's moving very much, isn't it, from high street based shopping and moving more to online shopping. So in that respect, businesses are starting to close down locations on high streets, close down parts of their business. So again, we need to start thinking there, is it a discontinued operation? So the examinability has come about because of the economic climate that we have experienced in the past and are likely, I suppose, to continue into the future. You just don't know. So let's go through there and think about, first of all, the non-current assets held for sale. Yes, this is a disclosure aspect to it because we're transferring an asset of PPE from non-current down to current, but this is where you tend to see a lot more of the numbers crunched with regards to exam style questions. So remember, there's nothing too different that we've seen before. The criteria about that asset being classified as held for sale still hold. So it must be available for immediate sale, and at the same time, it must be highly probable. So highly probable if we're actively marketing it. We are doing something in terms of trying to find a buyer, and then we're looking there to have sold it within less than 1 year. Okay. Once you've decided that it is non-current asset held for sale, if you like, that is the disclosure element, isn't it? So we're now no longer disclosing it as non-current, it is now current. You then have, if you like, the rules with regards to the numbers, and they're the bits that you tend to like. You like crunching numbers, you don't like to go through there and explain things from a narrative perspective, do we? So remember, we're valuing the asset at the lower of the carrying value and the fair value less cost to sell. So make sure when you have your fair value, you deduct those costs to sell. Again, if we're thinking back to the framework, we're thinking back there to the fundamental qualitative characteristics. We're thinking back to the faithful information that we are presenting to the users of the accounts. And by valuing the non-current asset held for sale at the lower of the carrying value and fair value less cost to sell, you're thinking there, aren't we, about prudence, aren't we? Okay. Again, remember, if you then value it at the lower of cost and fair value less cost to sell, if there is an impairment, if there is a reduction in the value as it transfers from PPE down to your current assets, then that is treated as an impairment. That impairment is recognised through profit or loss, I suppose, unless it has been previously revalued, in which case the impairment will go to where that revaluation has previously been stored up. Okay. Again, just note that if you have got your property, plant and equipment under the revaluation model, you need to revalue it to fair value first before you then reclassify as a non-current asset held for sale. So you have tended to see assets under the fair value, you've tended to see PPE valued at the cost model in financial reporting. You're more likely to see PPE valued under the revaluation model when it comes, to strategic business reporting. Okay, I think in memory serves me right, there was a question in the old P2, but I'm getting old. You can see the greys in the beard. So my memory is failing me, but you can have a look in your revision kit of your chosen tuition provider. I'm sure they'll have that question within there. Again, key bit, once you've reclassified it, you stop depreciating it, don't we? So you need to be careful. If you're looking at it from an audit perspective, directors will quite happily reclassify it as a non-current asset held for sale as soon as they can, because that then prevents any depreciation of that asset going through PPE. So you need to look at that as an audit risk, I suppose. And then remember, the subsequent sale gives rise to a profit or loss on disposal, being your proceeds less the carrying value that is there within the SFP. And don't forget that if that asset has previously been revalued, don't forget to reclassify the revaluation reserve and go through there within the statement of change in equity. Do that as a reserve transfer from the revaluation reserve to retained earnings. I think that's it. Okay. The next video we'll go through there and have a look at it with regards to some numbers. Strap yourselves in, folks.